Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week. Okay, hi everyone. Welcome back to Macro Insight. Today is the 24th of November, and let's look at the charts. So we've got Thanksgiving this week. So you'd expect most of the action to be done by sort of end of Wednesday. So let's have a look at what's going on. So the US market, let's have a look at the S&P chart. So we had a little bit of a pullback last week, and now we're just kind of rallying back. As usual, we had our weekly vaccine headline come through, this time from AstraZeneca, that gave the market a little bit more optimism, a little bit more hope. But you can kind of see each time that the impact that it's having on the market every time is less and less. If you look a little bit under the hood of the market into the rotation trade, that is still kind of ticking along nicely. So if you can see that the Russell 2000, for example, so S&P highs were around 3640. It's hovering about 1% below there. If I bring up the chart on the Russell, then you can see that's actually at the highs, right? So similar story, it had that little dip with the S&P last week, but it's kind of now come back up, smashed through the high, made some new highs. So that's where those small caps are benefiting from the whole idea that growth it may be coming back in Q1 with the vaccine potentially getting out there. Yeah. Now, if you want to look a bit more detail at some of these beaten up stocks on that same sort of narrative, so the stocks that I kind of use as my barometer for it are, so the airlines. So Delta Airlines is one that I like to keep an eye on. Delta, just because I think Delta is a better quality company than American Airlines. And so if I'm going to go long something, even though I know I'm buying garbage stocks, I'd rather buy the slightly better quality garbage, right? So that's why the choice between American Airlines and Delta Airlines was because that's a slightly better quality company, right? With maybe less debt, basically. So that obviously we got in early doors, kind of end of October, and that's kind of that's making local highs. So that's looking pretty strong there in Delta Airlines. Another one, Carnival's a big one. Same story. Carnival's there at its highs. Other ones I keep an eye on are the hotels, so MGM Resorts, and then finally Six Flags is another one, which is entertainment, and that's at highs as well. So that rotation from growth to value is still ongoing. It's being supported by these vaccine headlines that are coming through. We're expecting in sort of 8th to 10th of December some important news on the vaccine front. So that's basically they're going to get approval, right, to actually go ahead with these vaccines. So it's going to be important that they get the approval that they need. I think it's probably a bit of a foregone conclusion. But I suspect once they get the approval that they need on the 8th to 10th, if that's the kind of date that's happening, then you might get another final push in the market on the back of that. Right? So early first couple of weeks of December, kind of look out for that on the vaccine front. So obviously on the back of that, tech hasn't been quite as bullish. But tech hasn't been selling off that hard, right? So tech obviously had its initial sort of sell-off on the back of the vaccine rotation, and then it's just been chopping around and going sideways, right? So you've got some stocks within the tech sector that have done pretty well, right? Such as, so not your stay-at-home stocks necessarily, but for example, Tesla's been doing well, obviously with their S&P inclusion story. You've also had stocks like Square that have done very well on the back of the fact that they're long so much Bitcoin, and Bitcoin's gone parabolic, which we'll talk about later. But you have got some basically offsetting bullish stocks in the tech space that are making the actual Nasdaq go sideways, whereas otherwise it would probably go down, whilst all the value sectors were going up. So that's kind of the story in US equities. In terms of sort of fundamentals, what other news have we had out? So you had a bit of stronger US economic data come out on PMIs. We also had Biden saying that he's picking Yellen for Treasury Secretary, which the market's taken relatively well because she tends to be quite dovish. So that's a good thing. You also just got general seasonality, right? Santa rally, year-end rally, people sort of positioning for that. So, you know, that's kind of helping drive markets at the moment. I personally, I expect that to continue. I mean, people have been flagging that the COVID spike in the US is looking a bit, you know, exponential. And, you know, you still got Europe in lockdown, potentially extending some of their lockdowns. The UK is talking about lifting their lockdown as scheduled, but then introducing a strict 3-tier system, which is still going to massively impact, you know, how much we can go out and spend money, basically, right? So the Christmas may be cancelled to some extent in terms of Europe, because the amount of spending that people are going to go and do compared to what they normally would do just isn't going to be there. So you're going to have a massive drag on real economic activity throughout the entire Christmas period, right? Some people are calling it like a winter of discontent, yeah? So that's something to kind of be aware of, but it seems that even though that is where we're heading in the reality, the market's just looking past it completely and saying, well, yeah, we know it's going to be probably going to be a bad Q4 because Christmas is cancelled and we've got lockdowns, but we're looking into Q1, Q2 next year where vaccines are getting rolled out and the economy's reopening, and we're just looking past that, basically, right? Which, you know, you can understand because the stock market is usually forward-looking. But I guess the only problem is, have we been a bit too zealous at pricing in the vaccine that it's going to fix all our problems, right? If the vaccine really takes a lot longer to distribute, and we're talking about Q3, Q4 before you've got a large enough amount of people who are getting vaccinated that things can kind of go back to normal, yeah? And in the meantime, we've not got a fiscal deal agreed in Congress, and the fact that you've got blue versus red means that the kind of numbers that we might get are going to be probably lower than we wanted at first. You know, maybe there is a bit of a negative surprise on growth in Q1, Q2 that the market right now is very optimistic about. Maybe they're going to have to revise their expectations lower as we get into Q1 and Q2. So I'm thinking the market's setting up for a potential rally into year end, kind of seasonality, optimism on the vaccines, everyone thinking, okay, let's just look past what we know is happening right now on the ground. But then when we get to Q1, Q2, there's definitely the potential for disappointment. And that will be what I'll be looking for to potentially set up for some downside trades, but probably not until, you know, either really late December or sometime in January, depending on how the price action plays out. So that's kind of, and then on the, you know, kind of on that view as well, the VIX, even if the market doesn't rally that hard from here, so let's say we're capped at 3,700 on the S&P, the VIX can continue to drift lower into year end. And I think a range of kind of 18 to 20 as a target range for the VIX by sort of middle to late December is quite realistic. So I've still got some shorts on vol. I've gradually been taking profit as it's been drifting, but I've still got some on. I probably wouldn't take them all off until we get into that mid-December in that range that I'm talking about, okay? The other major thing in FX, obviously the pound. So if you look here, the pound recently has had a big rally from last week. You know, it's got as high as nearly 134. Then it had some really pretty negative bars. This is a 1 hour chart. Tried to retest towards those highs, couldn't manage it, selling off again. So a bit of optimism that a deal was going to get struck this week. I'm not a buyer of it. I've used that rally to sell. So I've got a little bit of a short. I increased it on that rally. I still think the risk is to the downside in the pound. So for me, that's where the risk reward is. I don't think they're going to get a deal done this week. So we'll see what happens. See that the most interesting story at the moment is what gold is up to. So if I bring up my gold chart on here. All right, so I've kind of marked out these two sort of big support levels. One was around 1825 and another one's around 1760. We've also got the 200-day moving average, which is this blue one here, which is around 1795. So I think just, these are the levels to watch. So I was talking about it last week after we had that big drop from 1960 to 1860, and then we kind of recovered to around 1900. Sorry. I was saying that I felt like the next move in gold was lower. I expected the vaccine optimism to kind of persist for a while. I thought there was a risk of real yields going up a bit. That was going to be bad for gold. I reduced some of my longer term gold exposure. I also put on a tactical risk reversal to hedge my long position. And now we're getting this thrust lower. So that risk reversal has done pretty well. It's made me some good money. I'm not rushing to exit it because, like I say, it's a hedge against my longer term positions. Like I said, if we get over the next sort of week or two, if we get down to 1760, I may look to roll down my hedge and monetize some of my hedge, or do something, play around with it in some way to monetize some of it. But at the moment, I'm just sitting pretty with my hedge and feeling quite glad that I've got it on, basically. For those people who were waiting for a dip in gold to buy, we've already hit that first support level. We're very close to the 200-day moving average. If you zoom out, often that 200-day moving average has acted as quite a nice support level and a place to buy on a longer term perspective. So accumulating some around here is not a bad idea. Like I say, personally, I feel like it's got a little bit more room to go. Like I say, that 1760 looks like a level that's pretty realistic to me. So I would definitely, if it gets down there, I would definitely be adding to the sort of long-term position if you are that way inclined and you like gold fundamentally, basically, right? So it's gold. Silver's going to be a similar story. Actually, silver not had the beta that it would normally have to a gold sell-off. Like, on a day normally when gold sells off 2%, you often see silver down 4, 5, even 6%. Silver's just kind of doing the same as gold right now. It's not actually having as much beta to the downside, which is quite interesting. I think some of that there might be some dynamic there on the industrial use of silver and the demand for silver on an industrial perspective rising, and that might be counteracting some of that. If we're getting a bit more pro-growth, a bit more bullish on growth, then that should kind of help silver a little bit as well, because it is an industrial metal, right? So it's got a mix of precious and industrial in it. So maybe that's why it's not selling off on the same beta that it normally would do to gold. In terms of support levels, we are at a support level here. I'm not rushing to buy it here because I expect gold to go lower, and that will probably take silver lower as well. I would look to maybe snap some up around the 22 area, and then there's a big level at 2060. I'll be surprised if we get as far as 2060 in silver, but if we do, then I would most likely pick some up down there. That would also coincide with the sort of 200-day moving average on silver, which would be a pretty decent size retracement from some of the moves we had seen earlier in the summer, where we'd really stretched massively above our averages. To get all the way back down to that 200-day moving average would be quite a nice place to buy again, right? So that's gold and silver. Copper is also an interesting commodity to keep an eye on. It's been very bullish, price action there. I had flagged that the way it was making consistently higher lows, higher highs. It's done the same again. It's gone to the top end of the range. You can see it's at the top Bollinger Band there, which means it may well be ripe for a pullback, but the trend is pretty strong in copper here. So in terms of, I would definitely want to have some copper on the book. I do have some in one of my portfolios, not enough, annoyingly, but I'm not really in a rush to exit that. I think having some copper in the book definitely makes sense longer term. I could see this thing running up to like 4 over the long term, yeah, and above, basically. So then I think Bitcoin's the next obvious thing to talk about. I mean, it's been a crazy ride in Bitcoin. Let's have a look. I mean, it's gone pretty parabolic, to say the least. So you know, once we had that little dip with gold, and then we just went higher, and then when we broke 16,000, we just went to the moon, right, and did a quick 20% basically. So that's been interesting. Just people, more and more people getting involved in the institutional community in this space, and realizing that, you know, there is some benefit to having Bitcoin in the portfolio. Obviously, you've had very positive headlines like the PayPal and the Square thing. And, you know, what I heard as well was that if you look at the growth in PayPal and Square and the users that they have, they are basically, arguably, they are going to soak up all of the new coins that are coming into existence in Bitcoin. So when you're looking at a supply and demand dynamic on Bitcoin to try and price what Bitcoin's worth, well, all the new supply is arguably being sucked up by the kind of growing consumer base of some of these big tech companies that are on board with Bitcoin now, right? So there's just that supply is being taken out, and there's more and more demand coming from asset managers and hedge funds that want to participate in this story and chase the price momentum, right? Ultimately, you know, there's a lot of price momentum chasing in all asset classes. And for people who are willing to accept that this is an asset class, then there is no price momentum like this, right? You compare the performance of Bitcoin to any other asset this year, I mean, it is knocking it out the park, right? There's nothing that's comparable, right? So to not have some, at least small allocation of your portfolio in an asset that's doing this and outperforming every other asset by so much would be a bit crazy, right? So I've been banging on about it for 6 months. The story hasn't changed. Obviously, the price has doubled since then, but, you know, just maybe don't chase it today up here at 19,000, but buying dips in Bitcoin is a bit of a no-brainer. Yeah, it certainly has been for a while. Now, the other thing was Ethereum, right? So Ethereum had been lagging. So as Bitcoin was exploding, Ethereum was kind of hanging around with not as much beta as it would have had. So to track this, normally you look at the spread, Ethereum versus Bitcoin. So you can see when Bitcoin was exploding, the spread between Ethereum versus Bitcoin was going down to the bottom end of this Bollinger here. And then literally in the last 5 days, Ethereum decided, okay, I'm going to join the party, and just outperformed by about 20-30% and completely reversed this move. So Ethereum is now again outperforming. It is a different use case. It's all about DeFi, right? And the applications of crypto and how it's going to change the way we do finance and a lot of other things. But, you know, this spread is quite a volatile beast. I mean, even today, this spread has kind of had quite a wide range. So, you know, I do think longer term, Ethereum is going to outperform, and you're going to see this ratio go to new highs. And like, I mean, if you look back, if we go really far back, if you go back to the 2017 bull market, where this ratio was, well, we were miles away from that, right? So, you know, at some point, could Ethereum's ratio to Bitcoin kind of go here, sort of 0.06, which is basically, you know, Ethereum outperforms by 100%? Very possible, right? So something to watch out for. Worth thinking about having some sort of Ethereum exposure in the portfolio if you are into crypto and you do believe in that story, right? I mean, it is a different use case. Bitcoin's use case is store of value, more of a currency alternative, payment system. Ethereum is just going to revolutionize a bunch of industries using blockchain, right? So they've got different use cases, but having a little scrap of Ethereum in your book in a smaller size than what you've got in Bitcoin, I think probably still makes sense. And then treasuries, I mean, it's a big debate really, what to do with treasuries, right? Are we really gonna see a material sell-off in the bond market? Are we gonna see inflation, or is it still deflation and negative interest rates on the horizon, basically, right? So I personally feel like over the next month or two, if we continue to see the rotation trade into value, we're probably going to see yields back up a bit. We're probably going to see US 10-year yields continue to go up a bit. If we have a look at where they are. So US 10-year right now is at 86, 87. You know, I put a long-term downtrend there. I can see it meeting some resistance around the 120, 125 area. I think that if we get bullishness on vaccine into year end, we get a risk on rally, we get dollar sell-off, we get kind of yields backing up, I think that's your kind of target, right? So probably a move from sort of 87 where we are now to about 120 in the 10-year. But I think if we get there, then that's probably a great opportunity to start buying bonds again longer term, because I don't think the structural dynamics are going to change. And I think over the longer term, the deflationary impulse is stronger. And I think, yeah, I can buy more into the idea that yields are ultimately going to end up going down again, right? And if we don't get the growth story kick in and we don't get the bullishness into year end, and actually the COVID situation gets worse, you know, Thanksgiving and Christmas are just a super spreader event for the US. And when Biden gets in January, he's forced to basically lock down all over the place. You know, that's your negative tail risk scenario. In that scenario, you can see the 10-year go to like 0, right, or close to 0, right? And so I think there is a risk of that. I'm basically starting to accumulate call options on TLT, which is the 20-year plus ETF on Treasuries, as a way of kind of trying to get some hedge exposure to that tail scenario that I don't think the market's really pricing now, of yields going down and going down hard again on some sort of deflationary surprise. Yeah, everyone's positioning for inflation. There's like big shorts in the US Treasury market. Obviously, commodities have been rallying. You know, people are chasing that reflation trade, and so the tail risk is that we actually get a surprise to the downside on growth. We don't get growth come through. There is no inflation, and you know, things are definitely not good. And we can see bonds reflect that basically, right? And if you look at European bonds, they kind of are suggesting that things aren't that great, certainly not in Europe, right? So, you know, just kind of something to be aware of. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.